Hey, good morning, everybody. Brian Dewald is here with us. I'm Matt Thomas. I'm a local real estate agent. Brian is a local mortgage professional, and as we do every week, we're here to touch base about the the world of lending and mortgages. It's such a volatile time in sort of the mortgage world, and so we thought it would be beneficial to have a series like this. And so Brian is quite honestly a phenomenal guest every week to have and be able to share his expertise. And so Brian, why don't you give us a quick update on what's happened in the last, say, 7 days or so?
Yeah.
And then I know you have a couple other points you want to go over with us.
For sure. Yeah. Appreciate such a nice, warm introduction. So thank you for that. So the last 7 days is
well deserved.
Yeah. Right. Thanks. The last 7 days has been well received, actually. So I'm going to even rewind the clock a little bit all the way back to the middle of June. Was when the first time that the Fed really started getting aggressive with raising interest rates. And I know that sounds super counterintuitive, and we've talked about that quite a bit, but oftentimes when it's an easy conversation at this point, right? When the Fed raises rates, most times mortgage rates get better. It's a little challenging to have the other conversation, which is when the Fed lowers, mortgage rates go up a little bit. So anyway, not 100% of the time, but it certainly trends that way the majority of the time. So.
Well, and I think we got to believe that if you're listening to this every week, you're aware that there's that inverse relationship, right?
Sure.
But I continue to hear, and I think it'll probably happen until the end of time.
Yep.
I continue to hear, gosh, the rates just went up, 3/4 of a point. Things must be doom and gloom, and they're not. It's like literally the opposite of that currently. So.
Right. Yeah, so
we're going to keep beating that dead horse.
Yeah, for sure. Yeah, it's good. And I literally have that conversation with somebody every day. So it's a very common misconception. And there's not a whole lot of really good information out there that says, otherwise. So,
Yep.
I've got a little blurb here. I'm going to share this. This was given to me from a colleague. So but I've got 4 good points based on Fed movement, right? So the first point is the Fed does not control mortgage rates. Come straight to the point there. Number 2, the Fed sets the federal funds rate and discount rates. These are the costs for overnight loans from bank to bank or from the Fed to member banks. Point 3, when the Fed cuts their rates or raises them, well, let me back up. When the Fed cuts their rates, mortgage rates can actually rise. Lower Fed rates can be good for stocks, so investors often sell mortgage bonds to raise cash for stock investments. When bond prices fall, mortgage rates rise commonly. Last point, this is the big one. Rates may already reflect Fed cuts. Investors regularly speculate and place bets in anticipation of Fed action. This will move markets in advance of the news. So, it's common that we hear, hey, we think the Fed's going to do this. And when that happens, that chatter starts to go on. The investors, whether it's in stocks or bonds or mortgage prices or anything else, we already know that. So we speculate based on their chatter and the adjustments are already made. So.
Well, it's kind of like when the news comes out, it's just confirming what the reports already are, right? So, that news is already out there and essentially. So the markets, as you mentioned, have already accounted for these adjustments, right? They've adjusted and accounted for that rate hike. And so it's already kind of baked in. We've mentioned that a couple of times. It's already baked in so it's not like if you hear that there's the Fed meeting next Wednesday, which that's not the case, but if it was, it doesn't mean that on Thursday, all the rates just fall out of the sky, or fall through the floor. So yeah, they've already kind of adjusted for that.
Agreed. Yep.
Good.
Yeah.
Okay, great news. You had something else you want to share with us?
Yeah, just a couple of quick pointers. When it's very commonly that I get asked, what's the rate today? And I wanted to share, there's about 10 probably factors that give someone an interest rate, and each of those factors can also have different adjustments to it, if you will. Fannie Mae and Freddie Mac call them loan level price adjustments. And I'll give you a couple of quick examples. The biggest one is a credit score, right? We look at the median credit score, meaning the middle. If there's 2 borrowers, we take the lower of the 2 middle scores. That's the biggest factor when determining an interest rate. However, there's lots of other ones, depending on how much someone puts down, right? Is it 3%? Is it 30%? All of those things can make a big impact in an interest rate. And again, these change daily. Go ahead.
Can you
Can you address why that is real quickly? Yeah. So the loan level price adjustments are this gigantic grid. Like if you've ever go back to your college days when you see these gigantic whiteboards, the fine print is about this big. And there's an adjustment for every which way that Fannie Mae and Freddie Mac can think of. And it's basically due to foreclosure data. They go all the way back to when they started keeping track, which was when our parents were little kids, maybe, or even before. But they're just solely looking at data. So in this box, the foreclosure data equals or represents this amount. So the more risk to any file, we get adjusted for a price every time. And it's all kind of behind the scenes, but they bake that into whatever the interest rate is at the time, or the cost, or a combination of the two. But at the end of the day, it's all based on foreclosure data.
Okay. Now, and that also affects, so when somebody puts down 3% or 30%, that's what you're talking about there?
That's one of the adjustments. Yep. Credit scores are huge. The longer lock we need costs more. If we look at a 15 or a 30-day lock, we're going to get a little bit better price than a 60-day lock per se. Sure. There's a big one right now are condominiums. There's a decent spread between a condominium or anything else. We classify anything else as single-family dwellings and townhomes. There's no legal description for a townhome, so they're classified as the same. And then occupancy type, right? Primary residence, secondary residence, which we call vacation home, another name for, and then rental property. So there's a bigger spread there than there has been, in years past. So lots of different factors.
So depending on the type of property that you're buying, that can also affect your mortgage rate.
Yep.
Okay. And I think probably a lot of people know that if you're an investor, the best rates are going to be when you're buying your personal home. When you're investing, you're buying multiple homes, you're not going to get as good of a rate. Or you just have to pay for it, essentially, is what it means. And then also with your like your vacation homes, as you mentioned. And then you said even as condos and such, right? It's just not quite the same rate.
Exactly.
Very good. Well, those are excellent points, Brian. I think, again, the whole goal of us meeting is to provide, good information that people can take and use. And I hope that people are watching. If you, and getting good information, good knowledge, there's a lot to learn here. The best point that I can make, of course, is when you're ready to buy a home, you reach out to Brian. Brian can walk you through all of these things. Obviously, you have a truckload of knowledge on all this stuff. And so, and the point is that everyone's going to have a unique situation. And so you're going to be able to just say, what's the right thing for you? And you can present that, and then people can make the decision that they ultimately want to do. But if you hear a rate like on the radio or on TV or it's advertised somewhere, there's a lot of things that go into that. And an advertised rate, people have to be careful about advertising rates because there's so much fine print. When they call you up, you're going to get the real story. But the good news is, Brian, obviously you can provide usually people with a lot of options or multiple options, I guess I should say. You and I have been working on, working with some clients recently who were trying to figure out a couple of different ways that they could go with financing. And there's always a couple of different ways that anybody can go with financing. So, okay, very good. Awesome information. So again, if you love what you're seeing, please subscribe, put a like, leave a comment, whatever. We'd love to answer questions. If we can send you some information by email, if you want to know what these points are, by the things that cause you to qualify or cause your rate to move up or down, and that kind of thing, we'd love to share that with you. So please reach out by email as well. Until then, Brian, anything else?
That's it. I'll have some more data for next week too.
Okay, great. So we'll meet with you and everybody else next week.
Look forward to it.
Take care, guys. All right, see ya.